Good morning, everyone, and welcome to our Wealth and SMSF forum. So today we have a slightly smaller panel. We have Jonathan Bayes, our Chief Investment Officer, and we also have Mark Johnson, who is the Chairman of our Investment Committee. Unfortunately, Olivia can't join us today, but so we won't be able to cover off the SMSF topic we usually would. But John is going to talk to us around markets. We've already had a question that has been asked by one of our clients, so we'll answer that question. I'm sure we'll have a few others as well. So thank you everyone for joining us as part of this series. And I'm now going to hand over to Jonathan Bayes, our Chief Investment Officer.
Thank you, Simon and Mark, and to all of you guys for giving us an hour of your time, or maybe a little bit less than that. I'm just going to shift to the presentation now. Bear with me as I share the screen. And then we'll kick on. 1 second. Thanks again for taking the time to sit in. What I've chosen to do with today's presentation is to drop the slides that have words on it, and just to give you a really visual picture of the things that we're looking at on the economy and indeed on markets, and hopefully lead you to the conclusion that we've drawn, being a cautious one. Again, I've been on the wrong side of that the last couple of months, but hopefully over the course of the next 30 or 40 slides, you'll be able to see the basis for that caution, and to give you a bit of what I think is a bit of reality, if you will, on where the global economy is at, and where markets are at in relation to the global economy. It goes without saying, this is general advice only, and you should be speaking to your advisor on anything relating to your own personal financial circumstance. And I might just jump on in. Again, if you've got any questions, please shoot them through on the question tab, or hold them off till the end. Mark and I are more than happy to help out with some questions answered. So first, where are we in the recovery? So I'm going to go through just the latest economic data initially, with a big focus on the United States and China and Europe, and we'll come to Australia in a minute. These bigger economies are what are driving the global economy, so it's important we focus on them first. This is my sort of go-to economic barometer. It comes out every week, so I don't have to wait each month for it. It's compiled by a very credible data source, which is the New York Federal Reserve. And this is an index that they've created as to real-time economic performance on a year-on-year basis, taking 6 or 8 proxies for economic activity. And you can see there the end result is that the US economy is growing at this point down 8%, 8.2% on where it was a year ago. We were down 11 to 12% at one point, and you can see consistently over the last decade, the economy's been growing, broadly speaking, in a range of high 1s to high 3%. And you can see there that whilst we have had a bounce back over the last month as the US economy reopens, many states started to reopen late April and then through early May. We are still significantly below where we were at a year ago, and certainly where we were before COVID-19 became the problem that it's become. So down 8.2% as a guide. A couple of other proxies just to share with you here. Same store retail sales numbers. This is actually part of what contributes to the previous index. They're running down a bit over 6% annualized at the moment. This is compiled by a group called Johnson Redbook. It's been around forever and a day, so again, the data source is a good one. And it reflects about 80% of US retail sales. So it's a pretty decent proxy. The point I would make on this one is that we are still below the rate of growth we saw back in the GFC. And remembering, of course, in the United States that they really did have a recession, unlike Australia where we sort of sailed through. we are still seeing significantly worse top-line trends than they saw in the GFC, even after the small bounce back from 10% down. This is another measure of retail spend in the United States. Again, not one particular proxy is going to be the right one. You can see that this one's a lot worse than the previous. This is again data through a particular payment platform in the United States, running down 20%, but again, still significantly down on retail sales on this measure pre-COVID-19. This is up to May, so there would have been a bit of an improvement in the first few weeks of June. Air travel. Again, a lot's been made about the recovery that we're starting to see in air travel. And this is from the TSA in the United States, and it's done on effectively a daily basis. These numbers are up until about 3 or 4 days ago. So this is passenger count going through TSA checkpoints, as you can see. Definitely improving, definitely increasing from the low points we saw back in April, but consider it what it was in the early part of March. We are still running down 70% in air travel in the United States. And I think that this is going to take a lot longer to recover, even in the US, where they've been slightly, less concerned by the outbreak from a government standpoint than we in the rest of the world have been. Because I think many of the states in the United States, and I'll come to this later, many of the states in the United States that have really done well in terms of stopping the spread, I think are likely to put up their borders to those states that are currently embroiled in crisis. So I think we're going to see mobility restricted in the United States from an air travel standpoint as states, such as the tri-state area in New York, New Jersey, Connecticut, who have gone through their horrible period and have now stopped community infections in those states and not wanting to bring in infection from other states. They'll force quarantines on travelers from, say, states such as Arizona, Florida, Texas, and the like, I think, in the coming couple of weeks. And as I say, that will have a big dampening effect on the potential rebound in air travel volumes. These are some interesting ones because this is a number that came out last night. The data set only goes back 3 or 4 years, but it's still a very useful one. There's many different measures of economic activity in each country each month. This one is pretty consistent with other data measures, but it does come out early, which is why it's useful. And it's consistently marked across the US, Asia, Australia, and Europe. The same people compile these surveys. And it's a purchasing manager survey encompassing services and manufacturing, so a really significant part of the economy in the US. And at 50, the way to read this chart, guys, at 50, the performance in that month is flat on the previous month. So above 50 means that we're seeing incremental growth on the previous month, below 50, the opposite. And you can see that last night's provisional number for June is still under 50. And we've been hearing a huge amount about this recovery as we reopen in the United States. The reality is that June was worse than May, despite the reopening. And I think that's important context when we get to what markets are pricing in. The next chart I'll show you is much the same, and it's from Europe. Again, below 50, and these are the compositional indices that come out, services, manufacturing, and then the composite, all below 50 in the month of June. And if you go through the individual countries in the Eurozone, France was actually flat, but again, they have had a much more significant impact in their economy than, say, Germany, which was still down. But it's more a stabilization than a recovery at this point. In China, however, things are definitely improving, but it's a domestic economy that is improving. The export side of things obviously remains very, very limited because the rest of the world is only just reopening. It's hard to get a real feel on local economic activity in China because sometimes the economic data can be massaged manipulated a little bit. And so there's a couple of measures that give a good true indication of what's going on in China. And one of those is electricity output. Again, electricity can't be stored, so it does tend to be quite a pure statistic. And you can see that in May, at least, we haven't had the June numbers yet, we've recovered back to growth in electricity output of about 4.3% annualized. So we're back into modest growth, but still well down on previous rates of growth. Small and medium business confidence is also improving in China, which is encouraging too. Back up above 50. Again, that's a similar sort of diffusion index where above 50 is positive month on month, but it's only marginally so. And some of the anecdotal evidence out of China is that until exports start to pick up, given that that is such a huge part of their economy, they will the extent of their recovery will be still quite muted. And the trade deal, isn't contributing a huge amount to either of the two countries either. And I found this a fascinating chart because we haven't heard much on the trade deal until yesterday, when there was a few inadvertent remarks by Trump's trade representative, Peter Navarro, about the trade deal being off. But it struck me to go and take a bit of a look as to the significance of that trade deal. And this chart is actually just a really neat one, because it shows, relative to the commitments that China made to the United States on purchases, where they are based upon sort of some guide of what they were already purchasing. And so you can see that the person who compiled this, and I think this is from Goldman Sachs, took Chinese imports and US exports as their rough base, and then compared to the commitments that the Chinese had made to acquiring more product, particularly on the agricultural side from the United States. And certainly in the first 4 months of this year, they're miles below what their commitment was. So Peter Navarro yesterday, if you've been reading the financial press, said that the trade deal with China was as good as dead. He quickly recanted on that remark, because the share market lost about 2% in the space of 45 minutes. But the reality of it all is that certainly the Chinese, and in fact the US, I think for other reasons, are not following to the letter of the law what it was that they agreed to back in late December, early January, when the trade deal was signed. This is something which I've referred to in previous presentations quite a bit, and I think it's really relevant because, again, if you're reading the papers and you're seeing the share market at all-time highs, and there's a lot of speculation that the market can run and run and run, and there's a lot of comparisons people are making to, the tech boom, and comparisons again to the recovery in 2009, neither of which I think are entirely appropriate. But the issue here is the difference between liquidity and solvency. And we, in the past decade in Western economies, have become very wedded to support from central banks. We've got interest rates virtually at zero around the world. In the case of the Federal Reserve and the ECB and the Bank of Japan, not only are interest rates at zero, but they're printing money hand over fist and inflating the money supply. And that has had a big impact on asset valuations. Not just the share market, but also to house prices and the like. The bond market obviously has had a very big rise. And the Fed, alongside governments around the world, and the ECB, Bank of Japan, and even the Reserve Bank of Australia, have all done an incredibly good job in the last 3 months at protecting the economy from the impact of shelter-in-place orders, which obviously are set in place to protect all of us as a society. And they have provided unemployment benefits and compensation in that regard. They provided huge amounts of liquidity to financial markets to ensure that companies continue to operate. But that is liquidity, and solvency is a very different thing. And liquidity is desperately important in terms of running your business from a day-to-day standpoint. But over the medium to longer term, businesses that don't have top-line sales that cover their costs become insolvent. And liquidity can't solve the current crisis in the medium to longer term because we need to see people back out being mobile in the economy and society and spending and they can't do that until such time as people feel confident that they're not going to contract the virus. And so we've had a really significant surge in liquidity, in fact, the highest on record. This is one of the reasons why people keep talking about gold, and I'll come to that in a minute. But liquidity in the United States has absolutely boomed, even so much so that if you compare that 23.5% growth in the money supply in the United States, compare that to what the Fed did back in the years following the GFC. You know, money supply growth only got to an annualized rate of growth half what we're currently seeing. So we're even more dependent upon Fed liquidity now than we've ever been. And this has helped propel share prices to higher and higher valuations, despite the fact that we are currently in the biggest recession that we've seen really since the 30s. And it's arguable that maybe we're even in a deeper recession than that. So at the moment, that liquidity is a short-term panacea, but it's not the long-term cure. And so I've sort of used the analogy or the metaphor of liquidity in this current crisis as being the morphine. It's pain relief, but it doesn't cure the underlying disease. The only thing that I think is going to cure the underlying disease is clearly a vaccine or better treatment that will ensure that people don't have the rather devastating side effects that COVID-19 can impact you on. Or we learn to mitigate the spread of the disease at a society level by wearing masks or far better contact tracing apparatus than we currently have. I think on that front, actually, the Australians we've done a terrific job in that regard, very well organised, much like many of the Asian economies. But in the United States, it's non-existent. This is again another demonstration of just how significant the stimulus from the US government has been to prop up the economy. So the money supply growth has come from both the government paying out $600 a week unemployment insurance benefits, from offering up non-recourse loans to companies impacted by the virus, as well as the Federal Reserve buying assets in financial markets. You can see that the fiscal deficit there is equivalent to a wartime spending package. It's enormous. And in fairness, around the world, this has been the case. At some point, the debt that's being accrued will need to be considered, but that will be a conversation for 2021 once we're through the worst of the crisis. And again, I will touch on that as we go through. And so back to that point of solvency. So despite the liquidity surge and despite the additional money in our unemployment benefits, we are starting to see delinquencies rise on mortgages. And so we've now seen a jump to 8% of all mortgages now over a month late in payments. And that data is out to the end of May, but that was released by a group in the States only 2 days ago. We're also seeing personal bankruptcies and corporate bankruptcies now rise. So this is some weekly figures that are reported. And I would imagine that as we come to the end of the government stimulus packages, which at this point in time is uncertain on precise dates at the moment, the unemployment insurance, the additional $600 a week of payments are due to finish at the end of July. It's very, very likely that that will be extended, but the terms are likely to change. There's concerns in the United States that currently states pay unemployment insurance, and typically it's in the order of $400 to $600 a week. So when you get paid an additional $600, it's actually been worked out that it's been very beneficial for lower income families. In fact, I could go off on a tangent here. The level of poverty in the United States in the last 3 months has actually been improved on account of the government handouts. So it says a lot for what it can actually do in terms of improving people's standard of living. But the terms are going to change, and it's quite likely that they will instead of paying out $600 a week, they will link the future payments to a person's previous wage and salary, such that the benefits aren't significantly above what they were previously earning, and thus giving them incentive not to go back to work. But it is likely that these things will be continued. But again, there will be a finite life on the extension of these payments, probably another couple of months, I would imagine. And the reason why, as I say, let me go back. The reason why we're seeing insolvencies rise and delinquencies on mortgages rise is because we just haven't seen such a significant impact on the workforce as what we've seen in the wake of COVID-19. And so the scale on the right-hand side is actually, it should be times by a million, or 100 million actually. It's the US workforce has fallen from over 150 million workers to 133 million workers anyway. The point of the matter is we've lost about 20 to 25 million jobs, which is obviously extraordinary in size and scale. So the unemployment rate and underemployment rate, so those people that are still working but working far less hours than they would like to, is 20% of the labour force in the United States. It's quite staggering. And that chart, I think, is quite amazing in terms of showing the significance of the lost jobs over these past couple of months. And it's really important to understand that there will be some permanence to quite a significant number of those jobs lost, not just in industries that are impacted, but by COVID-19, but across wider industries that are facing the prospect of just softer economic activity. The next chart just is a different way of pointing out the number of people that have lost their jobs. So this is continuing unemployment claims, still over 20 million people on benefits that have been on benefits for more than a week. So there's a huge amount of work to be done to get those people back to work. And this is just some context. Now this chart is about not a month old, but it's about 3 or 4 weeks old now. But it does provide some context for the scale of the employment recession that we're currently in relative to the past. And you can see that the impact is not only been incredibly immediate, but it's just been enormous relative to past economic downturns. And again, to recover from the significance of that fall, we need to see a pretty speedy return to work. And again, unfortunately, that is highly dependent upon the virus, not on central bank policy or on government policy. It's the old, you can lead a horse to water, but you can't make it drink sort of analogy. I mean, if people don't feel safe going out, then they won't. Over the past 3 months with Simon and Mark, I've talked a lot about the virus on these presentations, and so I've tried to limit it to one chart today. I think we're all a bit sick of it. I'm certainly a bit sick of following it, and to be really honest, I probably followed it a bit more closely than the market has. The United States shook off the concerns on COVID-19 literally halfway through the epidemic in New York, and it hasn't looked back. And I think that that increasingly now, given where markets are, and given that we're now starting to see a real explosion in infection numbers in the South and the Southwest, that it's likely that we'll start seeing people pay more attention to these clusters that are emerging in states such as Florida, Georgia, Texas, Alabama, Arizona, the Carolinas.
Apologies that Jono has lost connection. But what we might do is, just in the absence of Jono connecting back in, is just go to a couple of questions that had already been asked. And Mark, I might actually sort of point these questions to you so that we can continue on. But I thought one of the really interesting questions, which we would typically sort of point to Jono, would be one from an anonymous one, but a very good question, which is essentially a lot of the charts and commentary is on the US. Why should we not be looking at and considering Australian data and looking at those and analysing that rather than looking at what's occurring within the US? Can you maybe just give us an idea as to why it is that we point so much to the US? Obviously, it's a big part of the economy, but yeah, just give us a view on that, Mark.
Yeah, sure. Thanks, Simon. Look, in short, the US market is the biggest stock market globally, and what happens in the US dictates and leads to what happens in the rest of the world. Importantly, we need to focus on that market if we're going to get a direction for where our market is heading. I'm not sure whether we got to it in the presentation, but things like NASDAQ and those leading companies, and there's very much a concentration in the US market around technology. Apple, Google, these companies are sort of dominating the index and they've got some pretty high valuations. So those trends around technology are something that's more borne out and fleshed out in the US market. We don't have that so much in Australia, but at the end of the day, it's because they dominate markets and the world looks for the US for a lead.
Thanks, Mark. Just kind of flowing on to one of the next questions, and I thought John Morris's question was an interesting and a difficult one, and obviously it's very contextual, but the simple question was, where would you invest $10,000 currently? So a nice simple one for you, and I know that's very wide, but probably worthwhile to see if we can give a simple answer.
Look, I think in terms of investing $10,000 at the moment, comes back to what you're looking to achieve. But the reality is markets have had an enormous rally from the lows. Market's back at 6,000. There's a lot that's been priced in terms of the recovery. So there's been many conversations played out through the media that the stock market's looking ahead, and typically the markets are looking 6 to 12 months ahead of the real economy. And some people are suggesting at the moment there's a bit of a disconnect. From our point of view, we've been, and looking at that question, looking at clients' portfolios, markets have taking on a little bit of risk because they're making assumptions that how quickly the economy is going to get back on its feet and how quickly normal returns. And the reality is that's still an unknown, but markets have taken a view. But that comes to, when we look to placing clients' money and suggesting where that goes, we want to be investing in things that have got a defendable and stable cash flow. So things that are not going to be too volatile. And I would probably come back to recent recommendations about, things like Coles, things like InvoCare, things like Spark, where we're looking at those businesses and saying, well, Spark Infrastructure basically is distribution assets, Melbourne, Adelaide of electricity. So demand for that is going to be pretty strong. We've recently had the determination in terms of the reset of their Victorian assets and what the government will allow them to make. And that's come in as per expectation. So we're getting a 6% yield on something that's pretty stable. Happy with that. Death and taxes with InvoCare, they've come back a long way. Getting a 4% fully franked yield, we think, is a safe place to put money. But look, just to repeat it, it's those issues around stability of earnings and reliability that we're looking for, and not necessarily looking to chase the market because we think there's some risks in doing so.
Yeah, all fair points, Mark, and it's just about the market side of things, and it's interesting. We've had some recent discussions around gold, and I heard Jono was just starting to touch on that as part of his presentation. He was going to head in that particular direction, but just talk to us a little bit about gold and where it fits prospectively as part of a client's portfolio, and also just how clients, or how we would be suggesting our clients gain exposure to it and why. Can you maybe try to simplify it, because it's quite a complex area, and yeah, I think it'd just be helpful.
Yeah, so I guess when we start looking at gold, we look at some of the, some of the fundamental aspects about investing and why we do that. So I guess if I start and say one of the reasons we've probably been reluctant to have exposure to gold in the past is when you put your money into gold, and whether directly or indirectly, but you have physical bars of gold that you own as security or as an investment, it doesn't pay you a yield. And now, if we go back, when we go back a few years when interest rates were higher, then the opportunity cost with having your money tied up in an asset that didn't produce any return, and in total dependent on the economy and what happens with people's attitude to risk, then gold, can be a place that doesn't do much for you as an investment. And then you change that round to some of the mood that we're going on today. Well, obviously, in the first instance, we've got interest rates officially at 0.25%, so that what you're giving up by being in gold is certainly less. Plenty of client conversations of frustration with not getting any return on cash in the bank. And then the next thing we start to look at, and Jono's touched on this during his presentation when he's been talking about the amount of liquidity in the market and what's been happening with US currency. And they're starting to get some pretty sensible economists and commentators start talking about inflation. So inflation has been dead for a while, certainly below the RBA's target range of 2 to 3%. But with the amount of money that's been injected into the economy, that's likely, and there's concerns that when we get down the track a little while, maybe 6 months, maybe 12 months, maybe it's longer, that inflation becomes an issue. And gold is a natural hedge for inflation and wealth. And if we did see that start to move, commodities, but gold in particular, would be a safe place. And then there's some other commentary around where we're looking at, fiat currencies and how they're viewed when you get a heightened amount of nervousness and anxiousness by investors. So as a store of wealth, and as a safe place to be in heightened uncertainty, gold increasingly, makes sense to have exposure to. And we've certainly been looking at some comments from some of the major wealth management firms around the world that there's increasing interest from ultra high net worths in protecting the value of their money and protecting against inflation. So gold is being looked at a little bit more seriously, and not surprisingly as well, it's also been increasing in price. So it's certainly relative to where we are historically, gold has moved up, probably 30% from where it was pre-COVID. Not to say that potentially doesn't have further to go, but as a store of wealth and protection against inflation, it's becoming something that we're looking at a bit more closely.
Great, thanks, Mark. And you're the full focus today, so it's
fantastic.
So I've got another question for you from William Prentice, and just and this is always a difficult one, just talking about currency, the Aussie dollar to US dollar. Do you have a view? Do we have a view at the moment as to where that might be going forward?
Yeah, so I guess when it comes to currency, one of the key drivers has just been the differential between interest rates in the US versus Australia. And certainly when we start looking at money markets, we've got a premium in terms of our interest rates versus the US. And from that point of view, you know, we've had a rebound from the low. Certainly, you know, the Aussie currency did get down to 55 cents at the start of this pandemic and crisis, and has increased up to closer to 70 cents. In terms of a view, our view is that at around these levels, we think it probably stabilises, and we're not expecting it necessarily to get back to parity where it was a few years ago. So we think at these levels, it's probably going to stabilise and settle. I guess the caveat is currencies are always a very difficult thing to call.
I think you answered that very well, Mark. And we do have a question, a follow-up question from William, which I think is a bit more of a personal one, which is that my dog in the background? And yes, that is completely true. That's my dog in the background, and also my daughter who's home sick today. So I do apologize, but this is the I guess this is the new COVID. You can put a suit and tie on, but you know, life does go on around you. Look, you know, at this point in time, I think that you know, we've done a good job of trying to cover for Jono. I've received a text message from him, and I think that the NBN has done him no favours, so he's actually not able to log back in. So we do apologise for not being able to have a complete session today, but with a few different interruptions. But unless there are any other questions that anyone would like to log, we might. Oh, we've got one more from William here. Okay, so good question here. Thanks, William. So what sort of cash levels are we holding at the moment, you know, for clients? And you know, maybe we can just talk a little bit about that, Mark.
Yeah, so certainly with the run up in the market and a fair bit to play out over the coming months with, you know, JobKeeper payments. John earlier in the presentation noted that you know, increased delinquencies on home repayments and those types of things. And the other thing is just how much this rally in the market has not been about earnings, obviously. Forecast earnings are probably down 20%, 25%. So this market rally has really been about PE expansion or multiple expansion. So people taking the HARS or the rosy view or glass more than half full, and prepared to pay up more. And there's a few different elements to why people have done that and the different dynamics. Part of it is a view that came out of the virus, and it's more like a V-shaped recovery. And our view is that that's unlikely to happen given some of the fundamental changes in the economy, particularly in the areas around hospitality and those businesses not surviving, which some of those job losses will be permanent. So not so sure about that, but other people have taken that view. It's been a big price earnings expansion, and so we need another driver to kick in for markets take the next leg. And with the data that's coming out, we're expecting to come out over the next 3 or 4 months. We're of a view to be, you know, holding a bit over 10% in cash. And if we do get the opportunity to buy things at cheaper levels, we've got some cash to do so. So we're still, you know, whilst we're sort of 85 to 90% invested, we still want some money on the sidelines to take advantage of any possibilities or options of value that might present themselves over the next, you know, in the coming months. Jono, you're back.
Good answer. Yeah, Jono's back. The NBN has reconnected. Someone put the PowerPoint back in, so we should be okay. And I said I've got a little bit frustrated there with the tie. The tie's been loosened off, and
oh, has it? Yeah. Well, listen, I apologise to everyone there. And just while I bring it up, and I'll try and scan through these things because I know that there was 10 or 15 minutes lost. I can only assume that it was the NBN doing their work because everything went down. And I know that they've been doing work, so I apologise to everyone, and thanks Mark and Simon for helping me out. So listen, I might just quickly share this screen again, and then I'll jump through really quickly. And Mark, if you hear me going on a tangent that you've already covered, please just stop me. Okay, so let's go again. So I was talking about the clusters in the southern states. So, you know, again, I could have brought up Arizona, I could have brought up Arkansas. These numbers are only going to get worse. And the issue is, beyond the humanitarian side, the issue from an economic standpoint is that New York and California aren't going to let people that, you know, from these states come into their state without 14-day quarantine, and just going to stop people traveling. Okay, so the next few things, again, Mark, did you cover this, or are you happy for me to keep going? I'll keep going. There's been a lot of suggestion in markets and trying to suggest that the share market is not the economy, and that's very true in the short term, guys, very true. But in the long term, the economy always matters, because the economy drives underlying corporate earnings, and corporate earnings are a huge driver for share prices. This chart has been done by one of the fund managers at Pictet, and it's taken a mix of his lead indicators of the economy and matched it against the performance of the share market, particularly in the United States. And it's just an interesting case in point. None of these things are necessarily precise, but it is a very strong data set going all the way back to the GFC, and it clearly shows the line of best fit there of the economy and the share market, and a neat little trend. But what is very apparent is the outperformance of the share market relative to the economy, not just in the last rally up off the lows that we've had through April, May, and June, but also how expensive the market was leading into the sell-off in December, November, December through to February this year, which you can see up in the top right-hand corner. That grey dot of where we are now is probably even higher. And it does show this is actually a wonderful proxy for risk reward on certainly the basis of this 10-year data set. And it just shows how extreme the share market is now relative to the underlying fundamentals. Now, again, there's two ways that this can happen. The share market can come down, or the economy can do an almighty Lazarus and recover very quickly. And there's the potential for both. But the point I think that this chart shows is that we are above our skis, or over our skis now, from an asset price standpoint relative to the economy we've got, and reminding you of those charts that I pulled up earlier, just demonstrating just where the economy is in the United States, particularly, as still down, you know, en masse around 8% annualized, and only slowly but surely stabilizing for slightly better growth in the coming couple of months. So that is a risk. This chart demonstrates, again, more explicitly, the link between corporate earnings and the S&P. The S&P is the white line. The red line is a sub-index asked as part of the small business survey that comes out in the United States each month, asking companies how their earnings numbers are looking. And the last number that came out was from 10 days ago for the month of May, and that red line, understandably, given that the economy is in a hole, demonstrates earnings numbers from small businesses, you know, that are about a 5-year low, which actually isn't all that bad, to be honest, but significantly out of whack on where share prices are. And again, I'm sure you'll agree, pretty similar sort of time series there since the GFC, and demonstrates a very wide gap between share prices and underlying earnings. Next chart, just one of CEO confidence comes out every month, asking chief executives how they feel about the economy. The interesting thing there is it hasn't got materially weaker through COVID-19, but it was already incredibly weak in the lead up. So this is just another thing to keep an eye on, because CEOs obviously are looking out the next 12 to 18 months on their expectations for their business. And if they're more optimistic, they'll spend more, capital expenditures and the like. But at this point in time, obviously things are still very much in a hole. So Australia, again, any of you guys have met me or hear me talk, you know that I get given a hard time because I'm always looking at the glass half empty. So I've chosen to start more optimistically in this pack with just where we are relative to mid-January in terms of our mobility. Now, these aren't precise measures. Google does a really good one. There's a couple of other data series that I'd happily share with anyone if you're after them, but you can get this straight off the internet if you type in Apple Mobility, and you can check any country in the world outside of China and any state and any city. It's like the TomTom data that I've been using in past presentations. So anyway, this shows relative to January that as a general rule, we're driving, 10 to 15% less. so we're certainly improving, but we're still well down on where we were. Walking and public transport, much worse. And again, I come back to that point about, you know, how we spend in an economy. Driving a car to where we want to go to doesn't allow opportunity for spending. When you catch public transport or you walk or what have you, you are interacting in society in a lot more directer fashion, and you might buy a coffee or a magazine or lunch and the like. These are really good indicators, I think, of social mobility, and we're still well down on where we were in January. And these are some of the things that we've been spending money on. And I'd again like to draw attention to the positives and the negatives. Again, this data is all freely available on the internet. You can see there, this is from a group called Ilion. I think this is up into midway through June. Yes, 14th of June. And you can see what the trends are relative to, I think a year ago, the indexes, and where we're spending our money. So understandably, social activities such as the gym and going to the pub or a restaurant, public transport, well down. But you know, things around the home have boomed. And outside of food delivery and alcohol and the like, you know, most of the spending, like the surprise boom that we've seen from companies like Harvey Norman, JB Hi-Fi, Bunnings, Officeworks, a lot of these goods are one-time purchases, or bikes. I mean, again, Super Cheap Auto and their bikes franchise has done very well. You don't go and buy a bike every other week. It's a one-time expenditure. It clears the inventory, et cetera, et cetera. But once you bought it, it's bought. And the economy thrives on repetition and on the small activities such as buying a coffee, buying a lunch, going to the movies. And so the nature of the spending we've seen here, which has surprised me on many accounts, is unlikely to be sustained in the medium term. You're only going to go and buy one laser printer for your home office. You're only going to go and buy one new bike for your kids or your grandkids. We again need to see that social mobility pick up to get the service activity in the economy, both here and abroad, going. This is the Aussie leading indicator. It comes out each month. Westpac do it. Just shows you where their forward indicators of the economy look. I think the chart says it all. We're still in a big hole. Consumer confidence has bounced back. This is a weekly consumer confidence figure that ANZ report. Confidence is easy to win and easy to lose, but it is encouraging that we've bounced back in the manner that we have. So Aussies are feeling a bit more optimistic, which is good, but we're still not quite at the bottom end of what's been a pretty soft period for confidence really over the last decade anyway. You'll note that the dip that we got was back when Tony Abbott delivered that austerity budget back in 2014. It was pretty tricky times, as you might recall then. No business confidence, so businesses again still significantly down, rebounding back to how bad it was in the GFC, but still a very, very tough business environment. Business conditions and business confidence still miles off where they were in the last decade as well. And this is back to the issue that I raised before on employment in the United States. This is underemployment in Australia. So we're at 16%. The white line is a combination of unemployed and underemployed. And the red line, which you've probably seen me talk about before, is the wages number. But what I've done is I've inverted wages. Understandably, you know, the price of a commodity reflects supply and demand. So wages reflect the supply and demand of labour. We have a huge excess now of labour in our economy, 16%, as I say, of the total workforce. It would be even higher if several percent of the population hadn't dropped out of the workforce the last couple of months. And it points to wages likely at their lowest point in the last 30 years in Australia, wage growth. And in fact, the next chart shows that the ANZ are saying that we're going to get negative real wage growth in Australia in the coming 2 to 3 years. So again, living standards going backwards, which is slightly concerning. And this is why the government, in my opinion, needs to get far more proactive in their infrastructure plans than they already have. Building approvals. I talk about this on a regular basis because construction is a huge part of our economy. 10 to 11% of the labour force is in construction, and so this just shows demand for new homes, which is the white line. It's an index that is published by the Australian Industry Group. You can see there, it's like all the other diffusion indices I've shared with you in the past slides. At 50, it's break even on the previous month. You can see we're at 17. So the deceleration in terms of interest for buying a new house has collapsed. And it reflects pretty tightly, I think, for residential building approvals. So that red line, I think, is set to fall quite considerably. And note, of course, too, that in the last 2 years, building approvals for private residences have fallen from over 10 and a bit thousand a month down to where they are now, just under 9,000. But, you know, I'd be tipping they're going under 8,000 in the coming 6 months. So you can understand why the government were trying to encourage an uptick in construction activity, but I think it's likely to fall flat. I don't think it's nearly the stimulus that the economy needs. The economy needs big projects that employ an awful lot of people, that create productivity gains for us on a forward 10-year view, and they need to be a lot more expansive, I think, in that regard. Otherwise, again, we're going to see a very persistence of unemployment across both the construction and the retail sectors, both of which, you know, contribute 10% to the workforce each. Throw on top of that tourism, which is another, and tourism and food services, which I think is another 6 to 8%. You know, and you've got a quarter of the workforce that is facing significantly weaker demand. The one big positive for Australia as a nation, albeit it's not as important, unfortunately, as the previous negatives, is the trade balance. We've never seen such success on the export side as we've seen in the early parts of 2020. Record trade balances in March and April, and I'm pretty sure that May will be the same. And that's supporting the currency. And so, again, this is a chart you would have seen from me before, and it does point, in my opinion, to the higher Australian dollar. And it just shows that the spread of interest rate differentials in Australia relative to the United States, which is the red line, and that leads the white line, which is the Australian dollar. So in Australia, we haven't had nearly the stimulus, monetary stimulus, as they have had in the United States. Remember, reading back that I showed you that money supply growth in the US, almost up 25% year on year. The equivalent of that in Australia is up 7%. I think the Reserve Bank will be forced to do more in the coming couple of months, which will be a good thing, but it might be a little bit too little too late, and they might be facing the same problems that clearly governments around the world are facing, which is that, you know, you can lead a horse to water, but you can't make it drink. You know, you can't give people all this money and get them to go out and spend it if they don't feel comfortable in the community. I really am getting close to finishing, guys. This is actually kind of the important bit to tie it all together, because it shows how extended the market is, and promise you that there's only another 6 or 7 charts at the max. Okay. This is the share market valuation in the United States, 24, 25 times. We were high going into COVID-19, as you can sort of see there, at about 20 times. But with the downgraded earnings numbers, we're now, and that's as high as it's been since the tech boom. So very expensive valuation. These are the earnings per share, or the underlying corporate earnings of the S&P. Okay, so the one that matters for the here and now is the white line. You can see the fall away. 2020 earnings per share numbers have fallen from shade over $170 or $1.70 in the S&P to 124. So that's a 35% fall. The red and the blue are the forecasts for the coming couple of years. At this point in time, there has been no upgrade from analysts, no optimism coming through in their initial assessment of earnings for the coming couple of years. So share markets obviously go ahead of analysts, but at this point in time, there's a huge amount of optimism in share prices relative to any incremental uptick in expectations for corporate earnings from analysts. I would even argue that the red line there, 2021, of $161, which would be, broadly speaking, equivalent to what people were forecasting for 2020 before COVID-19, looks wildly optimistic. This is what you get investing in the Aussie share market now from a yield standpoint, which I think provides good context. So I could have pulled up the valuation of the market as well. It shows much the same thing as the US, not quite as extreme, but it is very, very high, certainly 20-year highs. But I thought this one does a much better job. This just shows the forward dividend yield on what is historically a high yielding market, Australia, down at 3%. Never been this low. In the United States, much of the rally has been concentrated in the big part of the technology sector. So the FANGs, as people call them. And this is an incredible chart from Goldman Sachs that just shows of the rise in share markets this year. And I think the NASDAQ, as at last night, is actually up 16% for the year, which is quite incredible. Those 5 contributors are up 23% themselves. The rest of the S&P 500 is down. So that's where everyone's making their money. And everyone is making their money, like the big international funds that we've got, which are performing really well, own that. And you can see how concentrated the share market has become with these stocks. So on the left-hand side, you've now got over 20% of the market in the US in those 5 big tech names. And on the right-hand side, and this is just a bit of a muck around that Goldman's have done, but a similar thing, they've taken, again, big pharma, big tech, and the big consumer goods stocks that shouldn't be necessarily impacted by the economic decline. And you can see there again that they're now up at almost a quarter of the European market. So the concentration in the market in these companies is as significant as it's been in 20 or 30 years. So everybody owns these stocks. Now have a look at the NASDAQ, which is a chart that I've pulled up before. And this is just really to show you the extremeness in the in price action. This is just a NASDAQ price chart on a monthly basis going back to the GFC. And it just charts a regression through the trend, the red line being the mean, and the grey and the green lines being 1 standard deviation and 2 standard deviations above the average. And it just shows how extreme the NASDAQ is now. It's pushing 4 standard deviations above the 10-year trend. And just to keep that really simple, that basically is a 1 in 1,000 event. So we are extreme. We're very extreme. And it would be my expectation in the coming couple of months, we see the share markets unwind. It doesn't mean that we're going back to the lows that we got in February by any stretch. I just think that certainly in many of the US names in particular and in Australia, there is the potential for over a 10% decline. But broadly speaking, the share market, I think, has the potential to fall 10% in the coming couple of months. And I'll explain why on the next couple of charts. We're coming into a period that historically has been weak for share markets. And that is the period that leads into a presidential election. So you can see from Morgan Stanley here that on the right-hand side, in election years, going back to 1990, or 1990, 1990, so whatever that is, 8 presidential election cycles, the average return from the 1st of August into the election is down 5%. As opposed to a typical 3-month return in the other 100 quarters of just under 2.5 or 3%. So we're about to go into a period of uncertainty, which is typified in election years where markets soften up. And you can see here that, and this is not a poll, this is actual betting on the election, which I think is a far better description of expectations, because the polls have been known to get it wrong of late. And this just shows how Joe Biden has surged ahead of Donald Trump in the presidential stakes. And under President Biden, you're going to get an increase in the corporate tax rates in the United States from 23 to 28%. Most of the brokers foresee this having an impact on corporate earnings in the United States in the order of 10 to 12%. Not only that, you'll get increased regulation, particularly across the big tech platforms. Again, remembering that, as I showed you 3 or 4 charts ago, that the market's very concentrated in those names. So you will get regulation there. Most of the global investors actually are watching the ACCC's decision on forcing big tech to pay for the news services here in Australia. They'll see that as a really big test case globally. And my understanding is that the ACCC are going to go very hard on this. So you even have a catalyst in the near term on the likes of Facebook, Google in particular in the coming couple of months. But also too on pharma, which has been an incredibly strong performing sector in the last few months. But there is a very strong will from the Democrats to rein in drug pricing. And so there have been measures, Sanford Bernstein, one of the brokers, saying that they expect about a 5% potential hit to sector sales, which would be akin to an 8 to 10% impact on profits from introduction of new legislation to cap drug pricing. So the risks are building up. And the reason I put the picture of the pirate ship up here is because I think it's a great description of momentum. We have a really quite expensive market at the moment going into a period that historically is soft, being the elections, with the leading candidate being left-leaning and likely to bring about higher taxes and higher regulation. So to me, just from a risk-reward standpoint, it does feel like that the optimism is nearing a nadir, and that the risk is that things swing back the other way. That's it. I realise that I probably have gone slightly longer, and I really do apologise for my communication problems earlier. I hope the pictures help. I'm more than happy to send this presentation to anybody who's interested, and maybe now turn it over to questions for Mark or myself.
So, Jono, thank you for that. That was good to finish it off. We've had quite a few questions just actually while you're offline, so there may not be too many more to come. But what I'd probably just ask you is that we saw Challenger earlier this week announced they were doing a capital raise.
Yep.
You know, we obviously had a lot of these probably 2 or 3 months ago. Do you have a view as to whether or not, you know, sort of end of financial year, you know, that we'll see many more capital raisings? People, you know, seeing either opportunity to raise capital and therefore take advantage of maybe some of their competitors' weakness, or just a genuine need for additional capital to run their standard operations. Do you have a view on it?
Yeah. So the answer is yes. I think that those people that immediately needed the cash went as quickly as they could. So Webjet was an example of that. We had Cochlear, which surprised everybody, which went with a very big raising as well. Reese have had a raise. I mean, a lot of these companies have raised. Now markets have bounced back. I think on the last webinar I said that the guy from Citigroup who ran investment banking, you know, was in the press saying they're encouraging every one of their clients to raise money into the market rally as best and take advantage of it now. And there's been a huge amount of debt raised in the corporate bond market as well with this liquidity provision. But so what we will see now is that those that haven't raised, that might need to raise, maybe if they've held off, let's see whether the economy improves. If we don't get the big snapback in the economy that people are expecting, we're going to see a second wave of raisings come through. Absolutely. The other thing from a corporate standpoint that everyone should be aware of, and this can be a negative or a positive, but ultimately for the economy it's a negative. In times like this, you see consolidation, and we are likely, I think, to see stronger companies taking over weaker companies, which if you happen to be in the weaker company from a share market standpoint, you'll do okay. But ultimately, it means more job losses because when you consolidate your business as a general rule, most of the times you're ripping costs out, and you're doing so to offset what is a pretty tough top line. And I think that there will be more of that in the coming 6 to 12 months as well.
Thanks, Jonathan. Look, and Mark Ainsworth has just said he'd like to get a copy of the presentation. So as Jono has said, we'll post this presentation in the normal course, but also send it personally to anyone who would like to get it. Now, we are over time. I think good job to get back online. Jonathan, thanks for that. Mark, thanks for stepping in and answering the tough questions. And I'm just saying here, just checking, there's a William. Good insight. We appreciate you saying the slide linking the S&P earnings forecast to current market share price of 4P says it all. Appreciate the insight. You know, lots of work goes into these presentations. So thank you everyone for attending. Your time is valuable. We appreciate it. And we will post this and we will see you in 4 weeks. Thank you again.